Alright gentlemen, in this video I'm going to be talking to you about how your internal audit cell is not actually delivering the value that it has promised. I'm going to be stripping the reasons down bare to the basics, and I'm also going to be spilling a few secrets based on real-time examples. I have been an internal auditor with a Big Four firm. I've handled multiple clients, including a Fortune 100 firm. My interactions have been right from the ground level of employees up to the guy who's been sitting in the CFO's office. Let's get started. To understand why internal audit is failing, let's head back to the origins. To put things in the right perspective as far as corporate governance is under concern, the employees have access to maximum information, the management a little less, the directors even a little less, and the shareholders the least. This does not make people comfortable. Everybody needs information. The only sort of information the shareholders received were in the form of quarterly reports or annual reports, but this was not enough. Information asymmetry. Shareholders wanted to know the accuracy of the financial reporting of all the documents that they read. They wanted to know whether the risk is correctly managed or not, and they needed some professional expertise on this as well, from a third independent and objective internal auditor. The shareholders also wanted to know that the policies and SOPs promised by the directors, how well is it complied to? Ergo, there came internal audit. It's no surprise that internal audit has often been dreaded by the employees. The auditors seem to look like twisted cops with more authority than what they can handle. Any non-compliance is looked upon as an opportunity to snitch out the culprit with a financial impact to the audit committee. To make things worse, there are more laws, standards, and guidelines. They are actually pretty professional. They try to create a robust framework around things, but not adequate stress has been laid on the right perspective. Let me give you a few examples. The new Companies Act, renewed in 2013, has laid a lot of stress on internal audit and risk management. Other guidelines and standards include COSO, IIA, and the ICAI, of course, in India. SEBI Clause 49 listing agreement actually states that the director of any listed company or a private company with a huge turnover needs to make a statement on the risk management practices and internal control framework. If this statement is found to be false in the event of something going down, he can actually go to jail. If you think this sucks, you haven't really heard of SOX or the Sarbanes-Oxley Act. Regardless, let's move on. Why internal audit? Let me tell you why internal audit came into place. Internal audit was designed to be an independent, objective, and consistent assurance and consulting activity. It was designed to add more value and improve operations. Here's how it has fared over time. Back in the day, the only assurance and consulting activity that people cared about was to see the compliance to the procedures and the accounting standards, as well as to manage a few risks here and there. Later on, something called PI or process improvement was added to this when people started laying more and more importance on the formulation and definition of processes for a professional outlook. There is still something missing today, and that is the future. We will come to this at the end of the presentation. Why does risk-based auditing fail to unlock value? Let's get down to the basics. Avoid the title, it's too complicated. Companies often stress that their internal auditors need to look for financial risk or compliance risk. When internal auditors do this, it hampers the relation between the auditor and the auditee. Let me first explain what is the meaning of financial and compliance risk. Any risk wherein the reporting is not accurate is a financial risk. Any risk wherein a policy or a guideline laid down by the board of directors is not complied to is a compliance risk. Basically, the auditor is playing the role of a cop. In a multidimensional view, I can say I have financial risk, compliance risk, operational risk, and strategic risk. Internal audit is capable of handling all four. But when you lay excess stress on the first two, that is financial and compliance risk, this is what your effort zone looks like. Now you can see the area in this triangle is the maximum. This is where your auditor is acting like a cop or is acting like an auditor. The remaining areas is where your auditor is actually acting like a consultant. This is what is missing. If we just change the perspective and we lay a little bit more effort, more focus on the strategic and operational risk rather than the financial risk and the compliance risk, the entire area shifts. This is a way better method of operating. When the relation between an auditor and an auditee is not right, information from the auditee to the auditor does not flow smoothly. You need to remember the auditor is not an industry expert. He is an audit expert or a process expert. The industry expert is the guy who's actually been working for you. This means your auditor is actually bound to miss on some crucial insight. The management often forget that having a good relation with your internal auditor actually means you can raise your voice through his reports. His reports are taken seriously. In my experience, I've seen this many times that the management has been saying the same thing again and again, but the senior management does not listen to this. If the same thing comes in the internal audit report just with a professional name, it is given a lot more importance. True story. The second reason that I like to tell you is that most people are blinded by fancy reputed internal audit firms. You guessed it right, I'm talking about the big four. Are you actually really impressed? Or are you love struck? You may be forgetting to ask some crucial questions when you hire these guys. Do you objectively verify the service delivery personnel's competency? Are the people that the big four putting on your place to service you, are they actually competent enough to service you? They actually charge you a bomb. Do you monitor their performance and productivity? It is impossible to go to an auditor's office and see him working continuously. That's not going to happen and that's not recommended. But what you can do is set weekly or other periodic targets and see how they fare against those. Do you ensure that their industry expertise is used? Now, most of you do not know this or you know this. Every Big Four firm has a huge knowledge repository. This knowledge repository is actually given free access to every resource who's been working on your industry. Is he actually using that in your report? Is that expertise actually coming out? It is one of the primary reasons why you hire these guys. Do you make sure that they refer these knowledge mines? Do you look for audit trails? There is something called a RACM or a RACM or an RCM, which is nothing but a risk and control matrix. It is the auditor's guide to audit. Whenever an auditor audits, everything is logged into his RACM. Believe it or not, there are firms who are doing all of these four activities. They do not just take a peek of their RACM, but they ask for it in hard as well as soft copies. Compromise objectivity. This is a really interesting one. Here are a few phobias that your internal auditor suffers from. I'm sure I'm going to get a lot of calls about this, but anyways, this is the truth. What if I issue an assurance or a blank report? I tell the client that I think everything is working perfectly fine. What if I cannot come up with a significant observation that adds value to the client's business? Will the client hire me again if the first two events occur? Big, big phobia. If I want to put this on a weighing scale, let me put it this way. This is your concern and this is your auditor's concern. All you care about is, am I doing something wrong? Can I do something better? Oh, I'm going to appoint some professional guys who have some great industry knowledge. Maybe they can help me out. But once you appoint these guys, the guy who's actually servicing you, his KPI or his promotion depends on the fact how well he services you. This is simple. He knows that he has to find something wrong, even if it's not actually there. Does it happen? All the time. You'd be surprised. If he finds and tells you that there is something wrong, there is a risk that is not mitigated as per his expertise, and he suggests a control to mitigate the risk, and you fall for it. Implementing an unrequired layer of control will prove to be detrimental to your firm. Please define your risk appetite and do not fall for this. Have a better atmosphere. I will come down to what can be done later. This is actually a conflict of interest. Do your operations actually exist in different locations? Have you hired different firms to service different areas of audit? Don't worry, I'm going to give you a simple example, and this is where I'm going to be telling you some secrets. These are some malfunctions that are happening even in Fortune 100 companies. I'm going to be giving you three examples, real time examples that I've seen during my career. Some of those actually happen even in Fortune 100 firms. Let's go. This is your procurement. It's either revenue or steady state, or CapEx, which is capital expenditure. Here is your accounts payable. Anyone will tell you this process is called P2P or procure to pay. You have two plants, plant ops 1, plant ops 2. After your plant manufacture whatever it is that you manufacture, you market it and you sell it. You sell it, you collect some money. That's your accounts receivable. This process is called O2C or order to cash. Now, of course, you have other functions like your HR, administrative services, other auxiliary functions like currency hedging, etc. And on top of that, you have your CXOs and your board of directors. I want you to know that all of these segregations are in different locations. There is a different internal audit team or a different internal audit firm servicing each of these locations. They're conducting an independent review separately. This is where it gets inconsistent. I'm going to give you a small example. In my time, I saw that one team that's responsible for revenue procurements negotiated a volume discount with the vendor. On the same day, or maybe a month later, another guy, but from a different team in the same organization, went and negotiated with the same vendor. Now the vendor does not care whether it's revenue procurement or capex procurement. For him, you are procuring. But in this, there was lack of communication between the two teams that were reviewing revenue procurement and capex procurement. They simply missed on the fact that together, when they combined the volume of procurement, the volume discount calculated is higher. The firm simply was about to miss out on the volume discount. The next example I want to tell you is that you should not pay your contractors unless and until they satisfy the statutory compliances for contract labor. This is monitored by your IR cell or the industrial regulation cell. The reason why I'm saying this is because when the contractor does not satisfy these statutory compliances, the liability does not lie on him, but it lies on you because you are the principal employer who's hired him. It's just the way the law is. I've seen this so many times that payments are made to the contractors without taking a clearance from the IR cell at the site. The third example that I'm going to talk about is actually one of fraud. There was a sales team. They kept meeting their monthly targets. It was very impressive. I've never seen anyone meet monthly targets in that manner. At the end of every month, the report that went up to the directors or the CXO was that our sales team has met its targets. But when you check the revenue is not high. How is this possible? The sales team at the end of every month showed fictitious sales. The inventory did not really move out from their godown to their customers, it only did in the system. The system reflected that the sales targets are being met. At the end of the month or at the start of the next month, these sales were reversed, showing customer complaints or rejections. It was fine. Now, when a different team is auditing the sales and the auxiliary function over here would be something like a team that deals with customer feedback or a team that deals with rejections. When these two are actually working independently without any consistency, nobody could have figured out that these sales, the rejections that they showed, were not actually rejections. They were just fictitious sales reversed in the system, done for the sole purpose of meeting that sales targets or creating that perception for their senior management. True story, happened during my time. What do we do about this? For risk allocation, you need to set the risk culture right. Please get this in mind. The auditors are consultants and not cops. Auditors have no great pleasure in surrendering people or taking people's jobs. Very important, the auditor needs information. Define the transparency norms for the auditor's access to information. As far as you're being flabbergasted by fancy firms, you should know that you should always interview the service personnel and monitor their performance. You can always have a nice model and define objective parameters for the same. You should always give a candid feedback to the guys you hire to audit and ask for their industrial expertise and RACMs. Every firm that I've worked with are asking for these. Objectivity. What do you do when your auditor tells you, no, this is a risk when it's not really a risk? Always cross-question your auditor whether an additional layer of control is actually required. You should define your risk appetite. You should know that every control comes at a cost. Higher the cost, lower the value. You're a business, you should know how much risk you're okay with. Another way of catching your auditor over here is to not compromise on an in-depth root cause analysis. Whenever the auditor is trying to sell you a control that is not really required, his root cause analysis of the situation will be inadequate. Try it. Don't believe me. To maintain consistency, it does not matter whether you hire n number of firms to audit different areas, something can always be worked out. Establish periodic communication protocols amongst the teams. It's the only way out. Something is still missing. I told you I'm going to tell you about the future of internal audit. You should know that internal audit also means a lot of data analytics. Auditors have access to a lot of information and they know many tactics and they know many softwares to analyze data. What they can do for you is look under the hood of your business. In today's environment, it's very dynamic. You need to make fast decisions. This only happens with the help of data or better business insights. The way you can leverage on internal audit is like this. Ask smarter questions. Define themes for the internal audit on these questions for the auditors to go and audit this across your operations. Use data analytics and modeling. There are many softwares available, including Excel, SQL, ACL, etc. This is going to give you a sharper business insight. This is the missing parameter. There is compliance, there's risk management, there's a better operational design using process improvement, and the last part that tomorrow we're going to see internal audit get into is getting the board of directors a better business insight. Why? You need to make fast decisions, better decisions. After all, staying in the game is the ultimate risk. Alright, that's all for this video. I hope you've enjoyed it. If you want to know how we can customize these solutions for you, please visit www.theorama.in or write to us at inquire@theorama.biz. Thank you.